Hello and welcome to FundooMoney, your 24/7 buddy for all your money matters. Over a period of time, as we invest in mutual funds, we end up building mutual fund portfolios. Often, we need to rejig the mutual fund portfolio after a major change in the market, persistent underperformance of an existing investment, or spotting a new investment opportunity. How does an investor go about rejigging or rebalancing one's mutual fund portfolio? We provide a brief primer on how to rebalance your mutual fund portfolio. When rejigging your mutual fund portfolio, you need to be guided by a basic understanding of asset allocation rather than misinformed opinion of others. Typically, two types of situations can spur you to rejig your portfolio, or in technical parlance, portfolio rebalancing. When existing investments and assets appreciate significantly. You may want to keep the proportion of your assets the same after a change in market conditions that alters it appreciably. Let's assume that you had 80% of your investments in equity and 20% in debt investments like fixed deposits and debt funds. After a market upturn, if the ratio goes up to 90%, you may want to bring the proportion back to 80% by selling off some equity investments which are either not doing well or have their best behind them. The sales proceeds are then investment in debt investments to get the proportion back to the original. Experts will call this as strategic asset allocation when new short-term opportunities emerge. The second possibility is when you spot short-term opportunities and want to tap them. For instance, after the outbreak of the global financial crisis in 2008, gold investments started doing well even as equity and debt investments lagged behind them. To keep the overall return from investments chugging along, you could have invested in gold exchange traded funds or gold ETFs offered by mutual funds. Of course, it was known that as the global economy would recover, equities will again do better than gold as they have done historically. Hence, the stepped up gold investment opportunity was a short-term one. These types of moves are not meant to alter your overall asset allocation strategy or strategic asset allocation, but to take advantage of emerging opportunities. These moves are called tactical asset allocation. Adjustments with sales, reinvestments, and fresh investments. Depending on the situation at hand, you can adjust your mutual fund portfolio with fresh investments or selling off existing investments and reinvesting them in asset classes when you are less invested in. What is the overall logic for this? By doing this, you ensure that your average annual return does not fluctuate too much. An investment portfolio growing well with relatively stable returns helps you save much more in the long term than a portfolio that touches the sky one day and plumbs the depths on the other. We hope you found this useful. Do share with us and others on the channel your views on managing mutual fund portfolios by writing in the comment section. For more such actionable personal finance information, subscribe to our channel. Also, visit our website, download our mobile app, and stay connected with us on Instagram, Pinterest, and SlideShare.